Welcome to another episode of Automotive Insiders. I'm your host, Jason Stein. Great to have you back listening again with us. Over the past 18 months, we've watched something quietly but meaningfully shift across the automotive supplier landscape. Deal-making is back. After a period of hesitation driven by interest rates, uncertainty around electrification, and broader macro volatility, 2025 brought a rebound in M&A activity across the supplier base. But this isn't just a return to normal. It's a more complex, more nuanced environment. Strategic buyers are being more selective, and distressed opportunities are surfacing in ways we haven't seen since the early pandemic period. At the same time, new variables are entering the equation, from tariffs and trade policy shifts to evolving deal structures. Also, the growing use of tools like representations and warranty insurance are managing risk in increasingly complicated transactions. So what's really driving deals right now, and what are the risks hiding, and how should suppliers be thinking about transactions this year? That's exactly where we're headed today. Joining us is Jennifer Dudley, partner at Warner, Norcross, and Judd, where her practice focuses on corporate law and M&A, with a specialty in representing automotive suppliers. We'll cover what's fueling the rebound in supplier M&A and how to protect yourself in distressed deals. We'll also dig into one of the more under-the-radar but critical issues right now, tariffs, and what recent developments could mean for past deals, current liabilities, and future transaction structures. It's Warner, Norcross, and Judd on Automotive Insiders. Jennifer, it's wonderful to have you on the program. Thanks for being a guest today on Automotive Insiders.
Thanks for having me.
Let's start off with M&A activity. I know it's your contention that M&A activity is or has rebounded to some extent. Can we talk a little bit about the key drivers and trends that you're seeing in those transactions? And do you expect those same trends to continue this year?
Yeah, absolutely. So, one of the things I guess to level set first is when I say it's rebounded in 25, and we do hope it continues to do it in 26, that's comparing it to probably the rock bottom of 2024, where everything was really stagnant. So rebounded, I guess, is a relative term. But what we're seeing is kind of in two different areas. We're seeing strategic consolidations, which are really being driven by market pressures, margin requirements, all the craziness with tariffs last year, inflation, stagnant sales, things like that. And then on the other side, we're seeing technology-focused acquisitions, right? Tied around or based around software, AI, advanced driver assistance systems, and even a little bit more back into the electric battery space. I will note there was a huge standstill in the middle of 2025 that was really a result of all of the craziness and chaos around the tariffs. A lot of the larger deals went forward, but some of the middle market still kind of sat around, and so we hope those will go this year.
That's exactly it, though, isn't it? In chaos, it sometimes freezes certain activity, and then once companies and the industry gets used to the chaos, it loosens up a little bit because there's a settlement into the chaotic nature. Is that fair, Jennifer?
That's fair, 100%.
Yeah. Well, and related to that, you have specific experience with distressed supplier transactions, particularly in the M&A space. For those who might not be familiar with what a distressed deal is, the seller is typically on the verge of bankruptcy, right? And they may have hired a workout firm and often is in default with its lenders and has maybe a list of outstanding payables that could be dicey. How do you protect a buyer for the seller's liabilities?
So the biggest thing for that is good due diligence at the front, due diligence with respect to the customers and the vendors and the lending relationship and its liabilities. And, because the struggle with a distressed deal is that typically you don't have a seller on the other side of it, where you might have typically indemnification or escrow or some other post-closing mechanism to go after a seller if there's an issue. In a distressed supplier situation, most of the time you're not going to have that. So you really want to make sure that you're doing good due diligence on the front end and getting as clear a picture of the liability environment as you possibly can. And the struggle in this space, by the way, is while you're trying to do this due diligence, you have a seller that is deteriorating probably by the day. So those two things can become very incongruent, and it can be very, very difficult sometimes to move forward on that. So, the main things that I would do is number one, negotiate with the customers, the vendors that you're going to need, suppliers, that type of thing. Most of them are going to be involved anyway because they're going to have their own issues with this seller, and a lot of times they're going to be happy that you're even in here. But negotiating with all of them at the beginning. And then also, one of the things that we've done is a sort of closing agreement where we address specifically where post-closing accounts receivable is going to be going, right? Those customers are still going to be paying the seller for a certain period of time for parts. And so to be able to contractually set out right at the beginning where those payments are going to go, which vendors are going to get paid, when the employees are going to get paid, and to be able to focus on number one, vendors, customers that you probably are going to need, but also areas where there's potential success or liability so that you can minimize the risk on the other side of the transaction for your buyer.
Let's talk about representations and warranty insurance. Could you give us a general understanding of how it works and the biggest pros and cons for buyers and sellers in the automotive space?
Sure. So RWI, for the longest time, we didn't see it. And now, especially in middle market deals, I've seen it in pretty much every transaction that I've done, and it's a really great tool in the distressed supplier space. So, reps and warranties insurance is an insurance policy, just like any other insurance policy. It's backed by an insurer, but what it supports is breaches of the reps and warranties in the purchase agreement. So, if you think about that, in a case where you have a distressed seller, they're not going to be able to support any sort of indemnification obligation. Well, the reps and warranty insurance can bridge that gap. So, from a seller perspective, it allows the seller to get their proceeds. It allows them to have a limited look back. It's a cleaner exit for them. And from a buyer perspective, it gives them somebody who has recourse against somebody so that they have an ability to mitigate some of their potential post-closing losses for breaches of reps and warranties. Now, the biggest caveat, I guess two caveats that I would put with rep and warranty insurance. Number one is that the insurer is going to do its own due diligence, which can be a positive because, especially in a distressed supplier deal, then you've got another party that is looking at the due diligence and looking for issues and that type of stuff. But insurers are a lot like lenders in that they work on their own time frame, and it may not be the same time frame that you're looking at. So it can slow down a deal. And that kind of segues into the second point, which is when they find things, typically known issues are going to be excluded from any rep and warranty policy. So, it will help you for unknown things, but for known issues that are discovered, and also usually for environmental issues aren't covered very often. The rep and warranty insurance is not going to protect you, and you're going to have to do something else in that case.
All right, let's talk a little bit about purchase price. How do you see purchase price structured and what factors drive the choice between structures? Are you any trends there?
Sure. So, the easiest one is cash. Cash is king. Obviously, sellers love cash because it allows them to walk away with money in their pocket. It can be great for buyers, but you have to have a buyer that has sufficient liquidity that they can outlay the cash. So the second is financing, either lender financing, seller financing, or some other third-party financing. The benefit of that is you've got a more credit-worthy entity that will be putting the funds in there. The potential downside is sort of similar to the RWI, is that if you've got financing, the lender's going to be doing its own insurance. And lenders are just like insurers. They work on their own schedule, which may not necessarily be yours. So, what I'm seeing more and more of are what I'll call kind of creative solutions and equity models. And those are the holdbacks, where the buyer may hold back a portion of the purchase price, either tie it to breaches of reps and warranties or just even tie it to time. Earnouts, which is allows the buyer or the seller to stay with the business for a certain period of time post closing, and earn some of its purchase price based on the success of the business post closing, which buyers like because it gives the seller an incentive to continue to build the business post closing. And even equity, to take an equity interest, either a rollover of your current equity or even a new minority interest. The struggle with earnouts and rollover interest is it's kind of like a marriage. And so, to the extent that you can be as defined as possible on the front end as far as the parameters for the earnouts, or when they get bought out on the equity, what their equity piece looks like, when they get paid, distributions, that type of thing, probably the happier the marriage will be, because it's a long-term relationship between a buyer and a seller. So that can have added complications to it.
Yeah, no, for sure. Let's go back to tariffs to close out here. And you mentioned tariffs as one of the drivers in M&A last year. We
Mhm.
know about the Supreme Court decision, and we know that there are mechanisms in place to process reimbursements on tariffs paid last year. A lot of that's in the headlines in the news right
Mhm.
now. Has there been any update on the establishment of that process?
Yeah, so the last that I heard, we're talking about $170 billion
Right.
in reimbursements and duties. This is big money.
Correct.
So the latest that we've heard is, CBP, which is the U.S. Customs and Border Patrol, they have informed, excuse me, the Court of International Trade that they will create a portal through their ACE system. So they've created this portal, and the portal's called CAPE. And their goal, they are telling everyone that they are going to launch it April 20th, which is next Monday. So it's obviously going to be a phased approach. Phase one, right now, they're going to start with unliquidated entries and entries that have been liquidated within the last 80 days. So, in other words, probably the most recent tariffs that have been paid. So, what we're advising our clients at this point is make sure your bank information is updated on the ACE portal. You make sure that you are ready to file your CAPE declaration if you are an importer of record, or that you're working with a licensed broker if you're going to go through the broker, and to make sure that you have all of your information. So, what's going to be interesting in this is that they've said refunds are going to be issued 60 to 90 days after the filing, unless, and I quote, a compliance concern requires further CBP review. So that's kind of making people a little bit nervous. And you want to make sure that you have, your HTS US codes, your Chapter 99 codes, country of origin, valuation of entries, all of the information that you're going to need when you file this CAPE declaration in order to get it through as smoothly and as quickly as possible.
Lots to sort out there.
Right.
We know that last year some OEMs negotiated with suppliers to share the tariff burden. If you're the importer of record and are reimbursed for the tariff, what happens next?
Yeah, that's a great question. I wish I could go into my crystal ball and give you one answer.
Right.
I'm going to give you the legal answer that everybody hates, which is it depends. What it's really going to come down to, I think, is what your contract with your underlying customer was. And for many suppliers, you probably have multiple contracts like this with each different customer. They probably have different parameters on when you pay back, how you pay back. On some of them, the reimbursement is even when you're entitled to it, not when you actually get it. And that can be a pretty huge delta, right? If you haven't gotten the money back from CBP yet, and all of a sudden you have an OEM asking for it. So the best thing you can do is, take a look at all of your contracts now with all of your different customers and make sure you know your obligations and you know your rights, because the customers are going to 100% be aggressive trying to recover money. And they don't necessarily look at their contracts. So you should 100%.
And to go back to M&A and relate it to tariffs, let's assume that one of your supplier clients bought another supplier who was an importer of record before the Supreme Court decision. Who gets the refund on the tariff?
So that's going to be another it depends answer. However, I will say that in the absent a specific negotiation, that is typically considered an asset of the seller. So it would stay with the seller. But the reason why this is a big deal right now is because you're probably negotiating new agreements with the customers, and you want to make sure that there is flow through there, right? So if the asset is going to stay with with the seller, you're going to want to make sure that also the liability and the obligation to reimburse the seller or reimburse the customer under the underlying contract is also appropriately addressed. And you may need to do that, especially in a distressed supplier situation, through an escrow, or the buyer may even consider taking that obligation on in those specific situations, just to make sure that the liability is dealt with just as much as the asset is dealt with.
Last thing, any specific reps and warranties in future deals to address the tariff situation?
Yeah, especially if you haven't gotten your reimbursement yet, you're gonna want reps about that all the tariffs were properly paid, that they were properly accounted for, that you've complied with all of your customer agreements, that you've taken all of the action necessary to claim reimbursement, that you've provided all of the accurate information. And then from the other side, that you have addressed the customer liability piece, right? That there may need to be, as I mentioned, an escrow or a holdback. I mean, the best thing you can do is try to put parameters and boundaries around what this liability and this obligation is going to be. And that allows you to best prepare for it in the future.
Jennifer Dudley, thank you so much. Very informative, very timely, and very much still unknown, but you've provided some answers here that we greatly appreciate. Thanks for being on the program.
Thank you for having me. I appreciate it.
Great. Thank you. Thanks again to my guest this week, Jennifer Dudley of Warner, Norcross, and Judd. Thanks for listening on this podcast platform. Come back to us for a library of more interviews throughout the year. I'm your host, Jason Stein. We'll see you again next time.